So I'm very happy to discuss this very exciting paper on a very important question. Just take that. Thank you very much. So, so we know that energy price shocks are not a thing of the past. And we still don't have much of a consensus about how best policy should respond to them. And we'd like to know if we're doing a good job in the United States, and European governments would like to know if their policy is well calibrated also. So this is a very nice paper and a very nice model for thinking through those questions. It builds on some related work the authors have in previous papers. And to understand it all, I mean, there's a lot of stuff going on here. There's a sticky price monetary model in the background, heterogeneous agent, incomplete markets model. And then this is in an international setting, so you sort of have to be on top of international finance too. So it's an all-star team writing the paper that they know all of these different pieces. I'm going to make one small comment, more about language and a framing comment before I go into much more detail. One is just that I think that internationally, probably there's a consensus markets are not complete. You don't trade a complete set of state contingent claims. And so I'm totally sympathetic to that view that we should be modeling international asset trade in an incomplete market setting. There's a lot of papers, though, I would say, that do that. So sometimes in the setting they talk about complete markets and representative agent as sort of synonymous. But I think you can easily think about a representative agent setting domestically and international markets that are not complete. And there's a bunch of papers that have done that. Okay, so their basic model has many, many pieces, a lot of things going on. And I am going to try to start with a very simple model and explain how some of these different ingredients work piece by piece as a sort of building up to try and get somewhere close to the rich model that they have at the end in the paper. So I'm just going to start with a very simple setup. Imagine there are two symmetric countries, each has a representative household. The far end country has some endowment of oil E that's going to be shocked. Imagine to start there are no nominal frictions, no sticky wages or prices. Each country produces the non-oil good using labor supply. And imagine that consumption in both countries is just a composite of the non-oil consumption good and oil, with some weights alpha and 1 minus alpha. I think you can think about this aggregator function for aggregating oil and non-oil. You can think about it as, well, oil and non-oil consumption are two different forms of consumption. There's some substitutability between them. Or you could think about it as that being, these are two different intermediate goods that are aggregating in production producing consumption. So you can think about, this is kind of intermediate inputs or different forms of consumption. Anyway, if we have this Cobb-Douglas case to start with, then utility just ends up being separable between consumption of the non-oil good, oil good, and labor supply. And imagine these two countries trade a bond. So in each country, the budget constraint says spending on the non-oil goods, spending on oil. You can borrow and lend in the bond, and you have some wage income. And then the world resource constraints, the oil consumption in both countries adds up to the oil endowment E, and then the non-oil consumption adds up to the total output produced in the two countries. So I think this is sort of a nice little model to start thinking through the effect of a shock to this oil supply E. Imagine that there's a negative MIT shock there, it goes down, and maybe it gradually comes back over time. So in this simple setup, what happens? So this simple kind of stylized model, nothing really happens. What happens? The price of oil is going to rise exactly by the same amount that the supply of oil falls with this Cobb-Douglas aggregator in consumption. Both countries are going to reduce the consumption of oil by the same amount. Neither country is going to change hours worked or consumption of the non-oil goods. So there's no spillover here from the oil shock to the rest of the economy. There's no change in the value of imports. The quantity goes down. The quantity of oil imports goes down, but the price goes up exactly the same amount. There's no international borrowing and lending. Both countries see real wages fall. They fall because the price of energy goes up. Both see aggregate consumption decline because there's less oil to go around, so that's kind of reducing total output. The real interest rate's temporarily high. But in this setup, with this Cole-Obstfeld sort of insurance through the terms of trade, a model with a single bond traded internationally is basically equivalent to a complete market setting. You're getting perfect insurance through the terms of trade. And because you have separability in preferences, there's no spillover from this change in the price of oil into hours or non-oil output. Okay. So second little model. Now, one important ingredient that Adrian talked about is the fact that oil and non-oil consumption are probably pretty complementary. Right? If you think about it as a production or consumption, it's kind of hard to substitute between oil and non-oil consumption. So suppose we have the same shock now, where these two inputs are pretty complementary. The price of oil is going to rise a lot more than the supply falls. I mean, OPEC has figured that out a long time ago. If you reduce the price of oil, the price is going to go up a lot. So this oil shock is going to be much better news for the oil producers than it is for the consumers. What happens in this flexible price setting to non-oil output here? So I think the answer is it's going to depend on how much households care about smoothing total composite consumption over time. If you really want to smooth total composite consumption and you've got less oil to work with, you're going to have to work harder to make up for that. Versus, on the other hand, how much you want to smooth this mix of non-oil to oil consumption in your consumption bundle. So to take an extreme example, suppose you really care a lot about this. Suppose that oil and non-oil, they enter in a Leontief fashion in this consumption aggregator. If you've got less oil input, well, you just want less of the non-oil input as well, because you can't do anything with this extra non-oil output you're producing. So in that case, if there's a lot of complementarity in the consumption aggregator, the efficient response to a reduction in oil supply is that both countries should reduce hours and reduce non-oil output. So that would be the efficient response. You get a non-oil recession. What about the current account? Well, here, the oil importer, this change in the price of oil makes them much poorer temporarily. So they want to borrow from the oil exporter, and that's what happens to the current account. Okay, so the paper says, well, that's a representative agent setting. Heterogeneity is important. They have a very rich micro-founded model with agents facing idiosyncratic income shocks and standard sort of borrowing constraint. Suppose to take a simpler version of that, we imagine there's just two types of workers. There are some people who will work and they're hand to mouth, they eat their wage income. And then there's another group that can borrow and lend. And in particular, they can access an international bond market. Okay, so now the same shock, reduction in the foreign oil supply. These workers, if they have balanced growth type preferences, they're not going to reduce their hours no matter what happens to the prices that they face. And so hours and output, actually in this model with these two types of agents, hours and output are going to be too high when the oil shock hits. Their model, they are going to assume that wages are sticky, so the labor market doesn't clear, and that's going to be, I think, an important ingredient in any Hank model. Because these Hank models, they have the property, if you have balanced growth preferences, wages are flexible so the labor market clears. Doesn't matter what shocks you hit the model with balanced growth preferences, the workers always want to work the same number of hours. So hours and output are going to be insensitive to any shocks in those types of models. So I think you want to have sticky wages. Okay, so that's the first problem, you're going to get too much output. The second problem is the importing country, the capitalists can borrow in the bonds, so they're going to borrow. Because this is a temporary oil shock, they want to borrow to finance consumption, they're going to end up consuming more than the workers. Okay? So you have output too high, and you get this consumption inequality problem that the people who can borrow are able to maintain consumption, the people who can't are going to consume too little. So the optimal policy is to transfer. You want to, maybe through deficit financing, you want to make transfers to the workers. That's going to increase the consumption of the workers. And through wealth effects, reduce their hours, and that's going to push you in the direction of efficient allocation. So transfers in this flexible price, flexible wage setting, those are going to improve efficiency, but they're going to reduce output. Okay, so now the bit that I get less comfortable with, I'm going to introduce a wage friction. Less comfortable only because I don't know this literature. So introduce a wage friction. So now suppose that workers are reluctant to let their real wage fall. I think that makes sense. I think a lot of workers in the US and in Europe are complaining that prices are rising faster than wages, and people don't feel like that's fair. Okay. So suppose now these two countries produce different goods, as in Adrian's model, and preferences are biased toward the locally produced good. So now with this wage friction, this energy shock is going to lead to a bigger recession. Why? Because because workers insist on real wages staying high. Firms pass that on in terms of higher prices, and that leads to lower demand for domestically produced goods on the world market. And that lower demand translates to lower sales, lower income, and lower income in a world with high marginal propensities to consume kind of has this multiplier effect, feeds back again into lower demand, and you get a further income decline. Yes. Okay, so what to do in this setting? So again, the capitalists, they can borrow. So again, you want to use fiscal policy to effectively allow the workers to borrow. Monetary policy now can have some real impact on allocations. If the importing government cuts interest rates, that's going to stimulate demand, raise the price for domestic goods. Firms are going to hire more workers and produce more output. Cutting domestic interest rates is going to depreciate the real exchange rate by the same amount, so you're going to preserve UIP. Now you might think that with the right amount of monetary stimulus, you can kind of undo the impact of this wage friction that's keeping wages too high. I think you'd want to think through, this wage setting model is a little reduced form here, so you want to think a little bit more carefully about how wage setters, whoever's setting wages in this model, how are they going to respond to changes in monetary policy? I don't think you can really answer that question in this model. And a good point Adrian made is that if you do stimulate demand by cutting interest rates, well, you're just going to increase demand for oil and further increase oil prices. So there's an unintended side effect there. Two very important messages in the paper. I think the first one Adrian presented very clearly. These energy subsidies are just a terrible idea. They increase the demand for oil. They push oil prices even higher. They look good for inflation, but only because in the official inflation statistics, you're measuring prices after the subsidy. All the extra inflation is sort of buried in the government budget deficit. I think it's much better to make transfers to people to deal with the cost of living, make transfers that people can spend however they like. For example, in the UK, part of the response has been basically to give everybody £400 cash that they can spend however they like. Better to do that instead of paying a fraction of people's energy bills. Second very important point that they made that I liked a lot was this idea that policy matters whether you think about a small economy or a bunch of economies that are coordinating. Single small economy can't do much about the price of oil. If countries altogether tax oil, that's going to reduce the price. If everybody subsidizes oil, that's going to increase the price. And in terms of thinking about coordinated monetary policy, if everybody tightens at the same time, it's going to reduce the oil price. So maybe there's some logic for that. But I still think at the end of the day, even coordinated monetary policy is going to be a pretty blunt tool for trying to bring down world oil prices. I think this is another message that I took from reading the paper and from thinking about it. These energy price shocks are fundamentally bad news shocks. Higher oil prices shrink a country's budget set. Lower oil supply for the global economy shrinks the set of feasible allocations that can be attained. So if you think about how to manage an oil shock, there's going to be some pain. It's just a bad shock. There's nothing to be done about that. You're either going to have to consume less or you're going to have to work more. And other shocks are going to look similar. It doesn't matter if you're thinking about lower supply of Russian gas, lower supply of Ukrainian wheat, or fewer microchips from Taiwan. These are inputs that are highly complementary to other inputs in production and consumption. A reduced supply of them is going to be a bad shock. So there's no way to avoid pain. The policy response that you take through the fiscal side or the monetary side, it's just a choice about how you want to inflict that pain on the residents of the country. The US, I would say, has chosen relatively stimulative policy in the last couple of years. So Americans are seeing the pain of these energy shocks mostly in the form of working more hours and to some extent in the form of higher inflation. Consumption in the US has been relatively strong, but even in the US, I would say consumption growth has been weak relative to growth in labor input. Sort of the trade-off you would expect in the face of these shocks. So I'm out of time. Just to conclude, I think the authors are doing a very important, very exciting paper. I haven't really done full justice to everything that's in that paper. I think it would be great to keep pushing in both positive and normative directions. What is the optimal policy response? And can we, in this context of models, can we explain some of the recent developments we see for particular economies? Thank you.
Thank you very much, Jonathan, for such perceptive comments. We have now 15 minutes for comments or questions. Please.
Great presentation and discussion. I'd like to ask a question about what the model can tell. I understand it's a way of the exercise that is being performed, but one can think that energy prices can move for some global factors that may also affect a small open economy, for instance, moving in R star or some other stuff that may come up, which is a way of the exercise. The exercise try to keep try to be clean in that sense. But one may think that, for instance, if the motivation of the paper is going to be the Ukrainian-Russian crisis, one may think that that affects all prices, but that may also affect R star or some other variables which interacted with heterogeneous agents models may give us some lessons that are different from a representative agent model. Thank you.
Any other questions or comments? I don't see any hands. I actually had some questions, if I may. I think the first point was about, that I already mentioned in the middle of your presentation, is because you look at the impact of wages and the role they can play in accelerating or not inflation. But I think profit margins may also play a role, particularly I refer here to the profit margins of the energy companies, which are supposed to have had quite a big increase. And my other question is, if I may, you mentioned that the elasticity of substitution between domestic and foreign was a little bit higher energy. But I think there's a question there of timing, because it takes time, particularly in the case, well, both of wheat and of oil or natural gas, to increase your domestic production. Say if you're going to start producing more renewables domestically or plant more wheat, it will take time. So the supply will be, response will be slower. And I don't know how that would be incorporated. So thank you very much. I see there are more questions now. Please.
Very interesting paper. I was wondering to what extent the kinds of rigidities you have in this model would also apply to thinking about the energy transition to green energy, and to the extent that that's very bumpy and you get shocks and these sorts of supply shortages, does that suggest some very negative aspects of the transition, or are most of those rigidities that you have in your model ones that would dissipate quickly?
Thank you very much. That's very interesting. Is it okay to get all of them together? We have more?
I have one. I guess two comments. The first one is that about the real wage rigidity and the sort of the union desire to increase real wages. I think there's some interesting case studies in the Eurozone, for example, because obviously countries are subject to the same monetary policy. But for example, Belgium has pretty much perfect indexation of wages to prices, and while Italy has very little indexation. If you look at the wage growth, nominal wage growth, in 2022 is over 6% for wages in Belgium, and it's about less than 2% in Italy. So your model has implications for obviously for the extent to which these two countries will go through falling output. So it would be interesting to I guess we have to wait a little bit to see what happens. But yeah, and the other thing is, in a model where you have say two sectors, one is that is more intensive in energy, the other one is less intensive. I guess adjustment would require a reallocation of labor. between the two sectors. So it's another form of like real rigidity that you know you might. Yeah.
I enjoyed very much the paper. I have a question. In contrast with Jonathan's model, which was like a general equilibrium model of the world economy, your baseline model is a partial equilibrium model in which the small open economy takes the dollar price of energy as given. Now, I think it's useful always to look at what's the first best response in that context. The first best response, if I'm not mistaken, would be one in which wages and prices, nominal wages and the nominal price all increase 1 for 1 with the price of oil, and nothing really changes. Again, because we're talking, it's a partial equilibrium model. Okay? It was full general equilibrium, that would not be the first best from the point of view of the world. So then you introduce wage rigidities, which obviously make the response to deviate from the first best. Now, when you introduce real wage rigidities, I would have expected these real wage rigidities to support aggregate demand somehow because of the higher MPCs of workers. But in your picture, you emphasize the difference in the response of inflation and so on. That was more plausible and so on. But the output was, I don't know if it was exactly the same, but it was really one on top of the other, which surprises me. I thought that a nice feature of real wage rigidities in this kind of models with high MPCs for workers is that they support aggregate demand in the face of fluctuations.
Thank you. I think there are a couple more questions, but can I just, maybe you have a lot already, maybe in the past, that maybe leave a little bit of time. How many more questions are there, Andres? Somebody else? Well?
Yeah, we can take more questions
Afterwards. Oh, now? Are you okay with that?
I mean, I'm writing down questions. I'm going to try to answer all of them.
But why don't you
I
go
have a
ahead?
simple question. In the case where monetary policy is coordinated, I didn't fully understand if, do you have like spillovers, demand spillovers from one of the small open economies to another one? And will that change the effect of this coordinated monetary policy? Like some kind of international spillovers of demand?
No, this is a question for Adrian. So, very nice paper. It seems to me that it's more for advanced small open economies, right? So, if you were to think about the type of frictions and limitations that emerging markets face, it seems to me that the toolkit is even more limited, right? Fiscal policy could not be expansionary because you would run very quickly into financial constraints, and monetary policy might not be as credible, right? So just to pick your brains on this. Thanks.
Thank you very much for the interesting question.
Great.
Quite a challenge.
Yeah, so thank you so much. Can you hear me? Is this working? Okay, great. So thanks so much. So first, let me thank Jonathan for a really great discussion, and we've had a bunch of conversations over the past couple of days. This is very stimulating. So first of all, just let me say, yeah, I agree with your point on complete markets versus incomplete markets representative agent models. We tend to take the complete market as a benchmark. It's also, say, in Jordi's work, typically, that would be the simple baseline. But I agree that incomplete markets are important. Now, we do study this. The thing about incomplete market representative agent models is they have low marginal propensities to consume, so for all intents and purposes, they really are very similar to complete market models. Complete markets are just simpler analytically. You mentioned the collapse result, which is with log everywhere. Basically, even with incomplete markets, it's actually as in a complete market model. Actually, that's our chi=1 case. So that's a case in which nothing really interesting happens. So everything happens that's interesting in our model with low elasticities of substitution. And you were covering the case with flexible prices, flexible wages, which I think is like a really interesting thing to think about, especially from the perspective of optimal policy. So you were mentioning this, and Jordi also mentioned the first best. So the thing about us is, optimal policy is very complicated in this model, and it's not. So you can think of the flexible wage case as kind of a useful anchor. So which is what would happen in the world without this wage rigidity, but that's not all of it. And Alistair's going to discuss a little bit considerations of optimal policy in these models. So targeting the flexible wage allocation is one thing you want to do, but you have these other considerations like distributional considerations. Monetary policy affects the distribution of agents, and so to be frank, in our model, we just don't know what the optimal policy looks like, and I agree, this is a place we want to go. We don't even know, it's kind of hard to define the first best. To Jordi's question, it's like we could have a complete market first best, but what's a useful notion of a first best that incorporates or a constrained efficiency that incorporates some of the frictions that we're thinking about. So it's a little bit tricky to think about. But yeah, so thanks so much for the discussion. You also mentioned like removing the wage friction. So in our model, that would be targeting the flexible wage allocation. So that's actually increasing interest rates. So monetary policy tightening to undo the effect on wages. Okay, so on Ernesto's question of moving R star, so we have an earlier paper about this. So there can be shocks to the world interest rate. And what those shocks are from the perspective of the economy is like capital outflow shocks. So say if interest rates go up, that's a capital outflow shock. So it's more reallocation between different countries. We think of this energy shock as a worldwide shock. So it's actually kind of better modeled, I think, as a shock to the world energy price than a shock to relative interest rates across countries, which would be like distributional shocks across countries. So they actually move the real exchange rate for the country. But the types of things that I've talked about are, there's very similar mechanisms for an exchange rate depreciation in a country. So if there's capitals that are flowing out of the country, normally that's expansionary in a representative agent model. In a heterogeneous agent model, that can be contractionary because the depreciation also lowers real incomes. And so it's very similar types of mechanisms where heterogeneous agents create a very different perspective. So your true question on profit margins, so I answered a little bit of it. So I know that there's a lot of focus on profit margins of oil companies right now and thinking about taxing the super profits and so on. So in our model, the way we have it, we can't really address this. So remember in our model, I said there's this world energy price that goes up, and there's actually price stickiness in the domestic economy level. So the energy companies are making losses. They're buying oil at the world price, and they're selling it at the stickier price domestically. So we don't think that that's particularly a realistic angle of the model. We think you need more deviations to think about the super profits. So I don't, we don't address this in this paper, but I agree that it's a super important and relevant topic. And on these questions of elasticity as a substitution, so it's clear that the elasticity of substitution is higher in the long run than in the short run. So we think of this analysis, and this also to Valerie's question on green transition, we think of this analysis as a decent analysis for thinking about the short run. It's even imperfect because we have C as demand, which we think of as actually a pretty bad approximation for what's happening to demand. For oil, say, there is a ability to store energy, so it's not just kind of today's price that matters, it's also what your expectations of the future price. Similarly, the model of supply is likely more complicated. We've been working on models where the elasticity of substitution can increase over time, but there's just too much to cover for this paper. But I agree that these are super relevant, important questions for this. And so Valerie, so the green energy transition, I think, is best addressed in a model without these rigidities, just because it's taking place over such a long horizon. And so probably a flexible price model would be a better model to think of this. Gianluca, I totally agree on the wage price spiral. So real wage rigidity is proxying a little bit for these indexations. So it's actually formally a little bit different to index directly wages to prices relative to the real wage rigidity that we borrowed from Jordi, but it's true, they have similar implications, and one of the reasons why in Europe some countries de-anchored wage negotiations from CPI was to try to break the wage price spiral, but it's still there kind of in contracts in some countries, and even if it's not in the contract, I think it is a big consideration that in wage negotiations people look at the headline CPI rate, and then that anchors how much they are asking in terms of wages, and And so that's why we think of this as super relevant for thinking about the wage inflation we're seeing now. Some of this could just be these kind of real wage concerns. So Jody, so I agree that the world economy is the way to think about this. So we have a partial world equilibrium here, which is just the equilibrium in the world energy market. But in an earlier paper on twin deficits, we were thinking about integrating your type of framework with a small open economy into like an actual global world economy, where things like R star are determined kind of at the world level. So I think that would be the type of model to start thinking about these questions. What's the optimum in a world economy? I don't have the answer for you, partly because it's, like I said, it's a bit hard for me to think about the first best. So Gaston, so you asked about small open economy spillovers. So here, yeah, all these spillovers are happening through the energy market. So it's a related question. We don't model the equilibrium in the world's good market, but we do model equilibrium in the energy market. And so there's already a bunch of interesting considerations. And then once you start moving to the world GE, then there's more spillovers of any domestic monetary policy, say on the world interest rate. And then on the question of on advanced economies versus emerging economies. So yes, I agree. One of the main things is just the fiscal space is much more restricted. So these energy subsidies that the European countries are doing are clearly not feasible. We think of this as super important, especially if you're in the world market for oil, and some countries are subsidizing energy and you're not because you have too limited fiscal space. But so that's one place in which there could be a deviation, but you can still take the general framework and just put restrictions on how much deficit financing you can do. So I'm not saying, I don't think the framework is the wrong one for thinking about emerging markets. And then to think about monetary policy, I mean, I think one of the things about these emerging economies is that they're much more open. So exchange rates matter a lot more for monetary policy transmission. In our model, that would be much less home bias, and maybe a bigger energy share. And so I think the same type of framework, but with somewhat different parameters. Less home bias, more restricted fiscal policy is perfectly appropriate for thinking about emerging economies.
Thank you very much.
Thank you.